Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market update. Hope everybody has been doing well today. So in today's markets, guys, we had a little bit of red continuation after yesterday's producer inflation report came in hotter than expected. And we're also on the watch, guys, for a few key structure breaks and daily downtrends on our major indexes. These are the things that we've been watching out now for a few weeks in a row, and they are materializing as we speak. So we're going to be paying close attention to our technical levels in today's video. Now, for the rest of the video, to start off, we do have a couple of earnings that I want to cover for you guys. Number one is going to be ULTA Beauty, which had earnings yesterday. Very, very powerful beauty company. So we're going to see how they did and how they compare with their main competitor right now, which is going to be e.l.f. Beauty in terms of their valuation. And number two, we're going to take a look at Dollar General, which also had earnings yesterday, and see if they are making some decent improvements in their business model and in their profitability after really falling off a cliff in 2023. Going to determine whether or not the stock is now in buy zone territory for the future, or if they are still facing some troubles, which could lead us to stay away from the stock. Thereafter, we're going to be covering our major rundowns here in terms of technical analysis from our major indexes and our major big tech names, of course. And lastly, just do a quick little recap on the end value of the portfolio for the week. So without further ado, guys, let's get right into today's video. SPY down about 1% off of that continuation off the negativity from yesterday, and QQQ pulling in a bit more to the downside, 1.19%. As a whole, guys, fairly red day in the markets as well. Was really a broad-based sell-off here. Whoops, that's the year-to-date performance. One day relative here, you can see that wasn't a very good day for most of your sectors. Now, you did have some green here in industrials and a few outperformers in financials, but for the most part, guys, fairly red day, and even your semiconductors were relatively mixed. NVIDIA was green for a portion of the day. It gave it back towards the end of the day in trading. AMD was really your outperformer, but for the most part, guys, tech really getting hit hard today again. And then you obviously had that negative return from Adobe yesterday. Adobe down, between 13 and 15% pretty much all day. On the one-day relative performance, guys, you can see that once again was a fairly weak day for the markets. We did have a few sectors coming in the green, as I showed on the heat map here. Basic materials, industrials, energies, and financials with a little bit of a green here. But to the downside, you can see the downside far outweighing the green, mostly because of the weight in the index as well, led down by technology and communication services. Communication services led down obviously by Google and Meta right here. So as a whole, guys, fairly negative day on the markets. We're going to take a look at the technicals and take a look at those key structure breaks. We're talking trend line breaks and also daily downtrends and closures below major moving averages. So fairly significant red flags, in my opinion, for potential further downside continuation over the next week or two. So we'll be making that determination a little bit later. For now, let's get right into our earnings previews, and we're going to take a look at ULTA Beauty first. So ULTA Beauty coming in, and they actually did fairly decent on earnings. You can see here, we actually had a double beat and fairly decent guidance, guys. They didn't give outstanding guidance, but the guidance was decent. Beat on EPS here by about 7.33% and a slight beat on revenue, not by too much, barely 1%. The stock, however, did have a significant drop into the early morning session, talking about 12%, only ending the day about half of that, roughly 5.21%, but still a relatively negative day on ULTA Beauty. Now, ULTA Beauty, guys, one of the problems that they've been having over the past 2 years is that their market share is not increasing, unfortunately. Now, this is a fairly large beauty retailer. Their market cap is about $26 billion, and they do bring in about, there's roughly $12 billion of revenue per year. So they are a fairly large beauty retailer. In comparison, e.l.f. Beauty, which is really the growth story for the beauty industry as a whole, is sitting at about $11 billion in market cap. So relatively, 2.5 times smaller. The leader in the industry, guys, is really a company like L'Oreal. L'Oreal is the worldwide leader in beauty products and beauty sales. And you can see that by their market cap, $240 billion in market cap. And on a yearly basis, guys, they bring in the most amount of money, talking about roughly $42 billion. So those are your industry peers that we're going to compare them to a little bit. Now, they are in a market that is not as discretionary as people think. So a big problem, guys, over the last year is obviously consumer discretionary spending. People are more careful on what they spend their money on. And usually beauty products, traditionally, the Wall Street definition of them is being discretionary items, meaning items that people don't really need. But guys, you know very well that in terms of the beauty segment, especially for women, well, those products tend to become an essential portion of those people's lives, right? So they're not really that discretionary to begin with. You will have a little bit of potential consumer, rotation to the downside in terms of what they spend their money on. But let's say you're going for some mascara or eyeliner or a lipstick or lip gloss and stuff like that, different beauty products, right? Well, when times get rough, you may not buy the $20 mascara product. You may just go down one tranche and start buying the one that maybe costs $10 or $11. But the one thing you definitely will not do is not buy it at all, right? And what's good about ULTA Beauty is that they really are such a well-diversified business that they have different tiers depending on the price points that you are willing to spend. This is something that Elf Beauty does very well as well, to where they have different products at different price points. So they basically have something for everybody. So I like that about their business model here. Now, they did announce $2 billion in buybacks, which is good. That's about 7.6% of your entire float for the next 2 years. That's a very good amount. They've been doing a relatively decent amount of buybacks, guys, here. You can see their share count over the past, let's say roughly 10 years, right, has been netly decreasing, and that will continue. So that's always a good sign that the company is deploying their decent free cash flow into those buybacks. They have very low stock-based compensation. I love to see that. They have a low amount of debt as a whole. Take a look, guys, as of their most recent report right here, you can see that in terms of their debt, they're only sitting about roughly $2 billion in debt, cash and cash equivalents, just under $1 billion here. But their free cash flow on a yearly basis is so good, guys, over $1 billion. So they are largely able to pay down that debt if they want to. It's not a problem for the company. Now, they also have decent free cash flow, just as I previously showed. Before we get into their valuation, though, however, let's get into a few of their earnings headlines, shall we? So ULTA Beauty beats on top and bottom lines in Q4 and revises its full year guidance. So here's some of the headlines. The company now projects its earnings per share to be in the range of $26.20 to $27, an increase from the previously forecasted range of $25.20 to $25.60. So this represents about a 7% increase in guidance for EPS, which is very, very good guidance increase for the next year. Now, the forecast for comparable sales growth has also been slightly revised, expected to be between 4 and 5%, a slight decrease from the previously projected range of 5 to 5.5%. So they will have a decrease in comparable sales, but keep in mind, guys, that in terms of these beauty companies, 2021, 2022, and for the most part of them, 2023, have been exceptional years for them. So moving forward, they do have some fairly tough comparables in terms of EPS comps and really in terms of revenue growth comps, but at least they are still growing. So that little pullback in terms of the revenue guidance is not that big of a red flag, in my opinion. However, the company has slightly reduced its operating margin outlook. Now foreseeing margins between 14 and 14.3% compared to the 14.6 to 14.8. So their margins are being slightly reduced here, but it's not egregious, guys, right? It's not a significant decline in margins, but for the revenue decline projections and the margin decline projections, which kind of offset your growth in EPS, that is one of the main reasons that the company was recently selling off. And at those current prices, guys, in the high $500 range, mid $500 range, actually, the company, as we'll see below when we get into it, is fairly priced. So anything other than outstanding earnings could usually translate, guys, into a little pullback in share price. They've had a substantial rally since year to date before their earnings, right? They were up about 20%. So the market was looking for better, and unfortunately, they just didn't deliver. Let's take a look at their press release directly from their company website right here. So this is what they had to say about their performance. We enter 2024 well-positioned to drive strong top and bottom line growth, build on our foundational capabilities, and unlock further advantages of our differentiated model. We were talking about those different tiers of pricing power that they have. While we are mindful of the near-term macro environment remains dynamic. We are optimistic about the resiliency of the beauty category, which we just talked about, energized by the growth opportunities ahead of us, and confident in our ability to deliver for our guests and our shareholders. The CEO continued, international expansion. This is a key point, guys, because they haven't done this before. International expansion represents an incremental long-term opportunity for ULTA Beauty to extend our reach and leverage our differentiated value proposition. We have evaluated different operating models and partners and geographies, and we're excited to announce the formation of a joint venture with Axo, a highly experienced operator of global brands, to launch and operate ULTA Beauty in Mexico in 2025. Now, this company has still not expanded internationally. This will be one of their first ventures internationally. They should have came to Canada. However, their plans to come into Canada, unfortunately, guys, got pushed back by the famous COVID pandemic, so they were not able to enter Canada, and they've since pretty much gone back on those plans. I think they opened maybe a few stores, probably just to test the market, but their full-scale expansion into Canada did not happen. This will be their first full-scale expansion into Mexico in 2025, so looking forward to see what happens with that. Now, here's their full fiscal year 2023. Some of the headlines here, guys. So net sales increased about 10%. That's very good. Gross profit increased 8.3% to 4.4 billion. That's a very good increase. So net sales and gross profit increasing, very good. As a percentage of net sales, gross profit decreased to 39.1 compared to 39.6. That's okay, guys. It's just due to some operating expenses getting slightly higher. Here you see primarily due to lower merchandise margin and higher inventory shrink. So even these guys have been affected by a little bit of theft. So their operating expenses did come slightly higher due to these two items right there. Now, they also had higher expenses in SG&A, right? Increased roughly 12.5%. As a percentage of net sales, SG&A expenses increased to 24 compared to 23.5%, primarily due to higher corporate overhead due to strategic investments, higher store payroll and benefits, higher marketing expenses, and higher store expenses. So the reason we go over these expenses, guys, is we want to get a justification of why the company is having higher expenses, and these usually do seem to be in line with the current macro environment. So really no surprises there. Higher wages, right? Higher marketing expenses because they've been having a relatively slower increase in sales. So you want to try to offset that with heavier marketing, heavier discounts. So that's why you kind of see those bullet points come in right there. Now, in terms of their share repurchases, guys, currently, as you can see, they approved a new share repurchase authorization of $2 billion. And these headlines right here just show that they just went through their most recent $2 billion that they had. So during 2023, they repurchased stock to the tune of $1 billion. Only 100 million remains under the 2 billion that they previously had set forth in 2022. So they're almost through that 2 billion. Now they have a new $2 billion, which is very, very good. As I said, guys, it's about 7.5% of their market cap. So very, very decent buybacks. Now let's take a look at some of the outlooks here. Net new stores. So they will be opening new stores. They run a brick and mortar business, right? So they do have a number of their different products, right? The ULTA Beauty line itself, which is their in-house brand. They do have that on Amazon, Target, and Walmart. But for the most part, they make a lot of their sales in their own stores. This is similar to Estee Lauder and other comparable retailers like that, right? A company like Elf Beauty, on the other hand, they do literally 99% of all sales online, so they don't have those heavy brick and mortar costs, which should prove to be good for them in the long run, should be bringing in more net margins than these traditional retailers. Now, in terms of remodels and relocations, they'll also be remodeling about 40 to 45 stores, so that's pretty good as well. Right? So very, very decent outlook for them. They are still growing, which is relatively good. And we kind of already went through a breakdown, guys, above of their sales, but their sales were relatively good. Here you can see that their expenses, yes, their expenses, guys, are coming slightly higher than anticipated. It's ruining their operating leverage a little bit. So I would like to see them, potentially manage this a little bit better moving forward in terms of just managing these SG&A expenses a little bit better. But for the most part, guys, it's nothing bad as a whole. Take a look at their 52-week net income. So their 52-week net income, guys, was about 11.5%. That is slightly down from their prior yearly period in 2023, which is 12.2%. But this company, in terms of net margins, they've really always hovered between, let me move myself over down here on the right, you can see that in the past couple of years, they're always between about 10 and 12%. So that's not necessarily a bad year for them, still moving in the right direction. Now let's take a look at their cash and cash equivalents. You can see about $766 million in cash and cash equivalents, as we saw when we went through the trading view outlook here. And in terms of their long-term liabilities, guys, all in all, it's anywhere between 1.6, 1.7 billion dollars in debt. It's really not that bad, if you ask me. And here's their stock-based compensation, guys. Stock-based compensation is so small. For the entire year, $48 million, guys, only. It's not even 1%, right? How much money did they make over the year period, right? How much money? Net sales, $11.2 billion, and they only paid $48 million in stock compensation. Excessively good. One of their best metrics by far. And here you see their free cash flow metric as well, which I highlighted. So free cash flow is just the difference between these two. It's net cash by operating activities minus their capital expenditures that they spent. So you can see free cash flow for the year is roughly about $1 billion, roughly in line with what they've been doing in the past, right? 1 billion, 1.2 billion on a yearly basis, which is very good. So as a whole, guys, the company is positioned relatively well. Social media exposure for them, because it's very important for beauty companies, right, to be partnering with a lot of influencers and really get their social media following up. I don't have TikTok pulled up, but let's do Instagram. Instagram, you can see they have about 7.2 million followers. And if you take in consideration their fastest growing competitor, ULTA Beauty, right? ULTA Beauty has roughly the same, about 7 million. So they're not really falling behind in terms of their social media exposure, in my opinion, at least based off of these Instagram numbers. So now let's do a little bit of valuation and compare them with ULTA Beauty, right? So revenue growth through 2027 is about 5.5% per year, and EPS growth through 2027 is about 10% per year. Now, those are all streamlined, right? So we have a really beautiful expansion curve here. No real red flags in terms of that, right? You don't see a couple of years down, couple of years up. It's really, really smooth as a whole. So at least this company is consistent and predictable, right? Now, in terms of their price to sales, it's roughly 2. We'll see why that's important when we look at ULTA Beauty. So this is signs of a more mature company, right? They're trading their PE ratio, if you take it on a forward basis for 2024, at their current share price, about $535, right? It's about a 20. 20 is not so bad for this company. But when we take a look at their PE ratio as an expression of their growth per year, their PEG ratio sit at about a 2. A 2 is just okay, guys. It's not amazing. It's not terrible. Anything between 1 and 2 is okay. I would like to see this better, more towards the 1.5 or lower, which would have been what you could have gotten, guys, sniping it all the way back here in November and even December. But right now, guys, at about $535, the stock is relatively fully priced. If you take a look at the analyst forecast for price targets, you'll see price targets anywhere between 580 and 690. 690 is really high in my opinion for this company, but I wouldn't be surprised if we can still go get, $600, $640 over the next year. Technicals also look fairly decent, guys. Personally, myself, however, I was looking to be potentially interested in this one if we come back down to about 480. We briefly touched 500 today, just not enough for me personally. I prefer ULTA Beauty as a whole. If you take a look at ULTA Beauty, even though this thing has been an absolute rocket ship, their growth is fantastic. So take a look at the revenue growth for through 2027. It's about 22%. EPS growth about 27.6%. So much higher numbers than ULTA Beauty, right? Much higher, you can see, than these numbers right here. However, right, we need to put them on a common denominator. That's why we use the PEG ratio, because it puts everything on the same ratio, right? Price to sales of 11. It's normal, guys. It's a high growth company. So the price to sales is never going to be that fantastic on growth companies. You can see sales metrics here are growing very, very rapidly, up to $600 million last year. They should be bringing in close to $1 billion this year, but still their market cap's like an 11, right? So it's 11 price to sales. Not the best, but when we take a look at their PE at $200 forward basis, about a 56, and their forward 2024 PEG ratio, so their PE as an expression of this growth, it is also roughly a 2. So pretty much the same valuation as a company like ULTA Beauty in terms of their growth prospects versus their share price. I like this one better, however, just because of how small the market cap is currently in relation to its competition. Take a look at their market cap, right? $11 billion. A company like ULTA Beauty is sitting at about $26 billion. So ULTA does have significant upside to it. A company like Estee Lauder, another beauty company, right? They're sitting at about $53 billion. Even after getting absolutely destroyed, right? Share price pretty much cut over in half. Their market cap used to be probably $100 billion. Now only down to 53. Take a look at the market leader. The market leader, guys, $240 billion, right? So that is just a potential that the company can can go and get. I would not be surprised if this company can grow into a $20 billion valuation over the next couple of years, which would be relatively a 2x in share price. I'm not saying that's going to come immediately because they are at the current price pricing in most of their growth for the next few years. But as I said, I would not be surprised, guys, if by 2027 and we get future expectations as well, I would really not be surprised if ULTA Beauty can continue gaining the levels $300-$400 over the next 2-3 years. Would really not be surprising to me. The valuation can stretch until that point, guys, before it becomes really, really rich, in my opinion. And if you take a look at the company like L'Oreal, the market leader, well, let's take a look at their valuation rates because I did that as well. Did I actually do it? So I was on the wrong ticker for the exchange in Germany. So as you can see, guys, revenue growth here through 2027, about 6.4 EPS growth for the market leader, about 10% per year. Their forward 2024 PE at $450, current share price. This is in euros, but it doesn't really matter. We're just looking for the metrics right here. Their PE ratio at 450 is about a 34.6, and their PEG ratio moving forward is about a 3.46. So this company is significantly more expensive than even a company like ULTA Beauty or ULTA Beauty. Personally, my own pick, guys, is ULTA Beauty. If we see any dips in this company, I mean, I've been in this company, guys, since pretty much last year at this point, right? Down in the $100 range. I would not be opposed to adding to the company if ever we get an extended market sell-off. Right down here, 170 down to about 160, even 150. I would be highly, highly convinced to buy some shares in that area. So hopefully that was helpful, guys. ULTA Beauty, really not that bad of a report, but really nothing outstanding either. As I said, guys, this one, for me, if I'm looking to buy this company to have a more attractive valuation, it really has to have a 4 handle in front of it, like 470, 460. That would be much better value in my opinion. So, but nothing wrong with the company per se, all right? So now let's move into our second earnings report, which is going to be Dollar General. And Dollar General, I mean, you guys know after Dollar Tree's disaster of an earnings the other day, I was very curious to see whether or not a company like Dollar General was doing any better. And you can see after their earnings, guys, they actually had a nice little rally early on the morning when they reported earnings up about 11% and then gave it all back, unfortunately here, guys, down pretty much that same amount. Right, yesterday, ending the day today positive, right? So really kind of a non-effect for the earnings here. They did have a relatively decent quarter, have to give them that. So in terms of their earnings, guys, they did have a nice little beat here on EPS by about 5.7%. They did have a nice beat on revenue here by about 1%. But we have to understand what has been the problem with this company, which resulted rather in a drop in share price to the bottom. About 60% of the company value got wiped out. Here's why. They had some problems last year. Now they had significant inventory buildup. We're going to check if that's still a problem for the company. This is obviously due to the pandemic, right? The supply chains were relatively crushed at that point. The company was worried about not being able to get inventory. So what a lot of companies did, like Walmart, Target, all the big guys, they just piled up on inventory. And now with discretionary spending coming lower, they have to sit on all that inventory, or at worst, liquidate it close to cost basis, which really erodes the company's margins. And that's exactly what they had to do over the past year. They increased the promotions because of that inventory. It absolutely crushed their profit margins, guys. And they didn't make that many profit margins to begin with. This is a company that was used to having, 7-8% profit margins. And in 2023, that got cut in half to about 4%, which was really, really, really terrible. And as a result, guys, their EPS got absolutely crushed as well. Take a look at this drop off. I understand pandemic years were tough comparables, but take a look at this net EPS drop off 2023, and they really won't recover, guys, to pandemic levels rather until 2027. Now, if you were to just erase these years from the company as a whole, you can see that we are better than 2019, and that will still move up. But still, guys, revenue never got affected. It's really their net EPS and net margins that got crushed as a result of having to discount that. And also, they've been plagued with theft. That's been a problem for dollar stores. It's been a problem for pharmacies. It's been a problem for companies like Target and Walmart, right? Theft has been on the rise in the past 2 years with this elevated inflation, and the company still deems that to be a problem. Now, what's the company dealing with right now? Well, they still are saying the same thing as Dollar General, that most people that go there, they're seeing an increase in traffic to their stores, but what are people spending their money on? Non-discretionary items, right? Non-discretionary items, which have low margins. So I gave this example when we covered Dollar Tree, right? People go in there to buy sodas, chips, dish soap, stuff like that, right? The margins on those are terrible. We're talking about, 2, 3, 4, 5% net margins. However, when they sell a t-shirt, let's say for $3, $4, or $5, they probably acquire that t-shirt for only $2. So the profit margins on those are probably a lot higher, maybe 30, 40, 50% profit margins on those. But consumers have not been opting for those. That's their home accessories division and their apparel division, which have really been lagging. People only spending money on non-discretionary items, basically your essentials, right? And now they have continued store expansion, which is good for the company, and their inventory is still high. So we're going to take a look at that. The only problem that they have in terms of their balance sheet, guys, they do have a high amount of debt. It's just a nature of the business model that they run currently. If I take you through most dollar stores, guys, it's just the nature of the business, right? So if we take a look at Dollar Tree, you'll see that they also have a significant amount of debt on their balance sheet, right? And in relation to their cash and cash equivalents on their balance sheet, it's relatively high. So Dollar Tree is about 10 billion, and they only have about $600-700 million worth of cash. Well, Dollar General is largely the same, guys. Even a little bit worse, actually, in my opinion. So the net debt for Dollar General right now is about 18 billion. Cash and cash equivalents, guys, of only about $600 million. So you can see debt is a problem for the company. And when you have shrinking profit margins and you're not able to pump out decent free cash flow, how are you going to pay down that high debt, especially at higher interest rates, guys? Just doesn't look good, continues to erode profit margins for the company. So before we get into a little bit of our valuation here, let's go over a few of the headlines for Dollar General as a whole. So you can see here, challenging year ahead as well. Once again, transition year. In its fiscal 2024, management believes that Dollar General will grow net sales by 6%, but its profit margins will continue to languish. The company is guiding for earnings per share of $6.80 to $7.55. For perspective, it earned $7.55 per share in fiscal 2023. Therefore, management is guiding for flat EPS in a best case scenario, even though it anticipates sales will rise. So once again, guys, the problem with having tough comparables from the prior years, they're just not able to expand EPS much before 2025 and 2026, undoubtedly when the macro conditions for consumers will be improving as well. Now, here's what the analyst says in terms of this on the Motley Fool. I personally believe that Dollar General can navigate out of its current situation, but right now it trades at about 20 times earnings, which seems fair considering management still has work to do to fix its profit margins. Well, we'll see if it's fair or not when we take a look at it. Part of the problem at Dollar General is inventory, and inventory per store is down 1%. That's a start, but the market might not trust the company's turnaround plans until it sees better progress. And that's what we're going to focus on, guys. We're going to really focus on the inventory. So let's go over a few other headlines. Not going to spend too much time on this. So as of February 2, 2024, total merchandise inventories were at cost $7 billion compared to $6.8 billion in 2023, a decrease of 1.1% on a per store basis. But still, guys, right? Still highly elevated. Take a look at some of their highlights. Same-store sales increased 0.2% compared to fiscal 2022. Not very good same-store sales growth, is it? Driven by an increase in customer traffic, however, partially offset by a decline in average transaction amount. So more people coming in there because they're pinched with money, but they walk out of the store with less items, and the items that they do buy are essential goods that are low margin, right? So all companies have been having this problem, guys. Walmart, Target, Dollar Tree, Dollar General, the list simply goes on. Same-store sales increased in the consumables category and declined in the home products, seasonal, and apparel categories. Those are their larger margin categories. Now let's take a look down here. Share repurchases, are they doing any? Well, in fiscal 2023, the company did not repurchase any shares under its repurchase program. The total remaining authorization for future repurchases was $1.4 billion at the end of the year. However, they don't plan to do any in 2024 either. The company's guidance assumes no share repurchases in 2024. However, they are opening new stores with their cash. The company is reiterating its plans to execute approximately 2,400 real estate projects in 2024, which is very good. 800 new store openings, 1,500 remodels, and 85 store relocations, guys. Now the company has about 17,000 stores nationwide. It is the largest dollar store by sheer amount of stores. Now here's some comments by the CFO. We're encouraged by the progress we're making with our efforts in getting back to the basics, and we anticipate the benefit of these actions will continue to grow as we move throughout 2024. While we anticipate the first quarter will be pressured by our lowest expected same-store sales increase of any quarter in 2024, very low numbers, as well as the annualization of prior year headwinds such as retail labor and shrink, once again, fancy word for theft, we are focused on delivering our full year plans, including anticipated strong EPS growth in the back half of the year. So basically saying the first half is going to kind of be slow, but the second half should be netly improving. Now let's take a look at their inventories, guys. And this is really the only thing that I want to show you guys about this. We already know the company has razor thin margins. They're trying to deal with expenses as best as they can. Here is the problem. Merchandise inventories, $7 billion. It grew on a year-over-year basis. Now, why is this a problem, guys? Well, keep in mind, guys, right? It costs money to store inventory. At least most of their inventory is not perishable, but you run the risk of having stale inventory in terms of new products and stuff like that. Dollar General doesn't really have a large product mix to begin with, but you never want to be in a position, right, where you're offering consumers products that are 2-3 years old potentially, right? Maybe there's a newer, better product currently out on the market, and you really want to be able to turn over this inventory at least once per year, which they were doing in the past. Now, I did pull up some previous balance sheet statements for you guys just to show you how big of a problem this is, right? So take a look. Here is their 2019 and 2020 inventories, right? So you can see here, one year is about $4.1 billion. The other year is about $4.7 billion, right? At this point in time, they now have $7 billion. So it's largely above, right? About $2.5 billion above how much they had prior to the pandemic. Now, why is that a problem? Well, the revenues from those 2 years have not really increased that much. You can see 2023 here, they're about 33 billion, and now they're about 38 billion. So about a 10% increase. Have we had a 10% increase in inventories? No, we've had very substantial increase in inventories, right? 30-40% increase in inventories. And it's a problem when you have so much debt, guys. That extra $2.3 billion that's just sitting there in inventories could be used for other things, such as opening new stores or paying down some of that $18 billion of debt. That is why inventories are a problem, and you can't get through this amount of inventories without doing heavy discounts. And obviously those heavy discounts tend to hurt margins again. So that's the problem for the company, guys. Taking a look at their financial metrics here, revenue growth through 2027, about 7.5% per year. Decent EPS growth through 2027, which will only be starting at the end of 2024 because 2024 is going to be flat. It's about 13% per year. So if we take their forward end 2024 PE ratio at about $150, which is the current share price, it's about a 20.7. Just as the Motley Fool guy said, 20, it doesn't seem so bad. Well, let's put it as an expression of their growth. As an expression of their growth, guys, it puts them at a 1.6 peg. Not the best, if you ask me, right? For a dollar store, especially if you want to be buying this when it's absolutely crushed, I was expecting it to have a better peg ratio, but unfortunately it's 1.6, which is not towards the cheaper end of things, guys. Closer to 1 is what you want to see when it's such a great deal that it just jumps out in your face. So this one, not that good of a deal, right? Even Dollar Tree, we took a look at Dollar Tree the other day. Their peg ratio is still better than Dollar General's, even though their share price hasn't dropped as much. Their peg ratio is about a 1.2. Now, the company that reports earnings next week that I want to take a look at here, guys, is going to be Five Below. So they're in that same category, right? Five Below, if you don't know what the store is, guys, they basically sell items in the store that are all $5 or below. So it's not really a dollar store, but it kind of is, right? A little bit of a different business model, but not really. So here you see, I did some ratio analysis for you guys as well. Their peg ratio at their current share price is about a 1.81. So that is, pretty much the highest one of the group. But then again, it is also the one of the group that did not get negatively affected by this consumer discretionary spending cycle, and also which has the fastest growth prospects over the next 4 years. You can see there's a revenue ramp and EPS ramp as well. So I'm very curious to take a look at them. They will report earnings, as a matter of fact, here on next Wednesday after the close. So very curious to see how they compare to that, because I kind of do want to make a little bit of a play on one of these dollar stores if ever we are supposed to be in an environment where inflation is still high and consumers are pinched for their dollars into 2024. There may be a little bit of a trade to be made here here with some of these companies now starting their recovery stories, or a company like Five Below, which really doesn't have any of these problems. So that's why I want to take a look at that one next week. So that's pretty much everything we had for our earnings today. Now let's dive into some so actually, you know what, guys? Right before we do our technical analysis, I did want to mention something. Now, in terms of the earnings we have for next week, you'll see that it's fairly dry. However, we do have a couple ones that I want to look into for potentials for trades. Now, number one, guys, is going to be Five Below, as I just mentioned. On Thursday, however, we do have Nike, Lululemon, FedEx. That's going to be the big day. The rest of the week, not much. The one that I want to take a look at, well, we do have Micron on Wednesday, semiconductor play, right? So the one I want to look at, sorry guys, I'm all over the place. Chewy, right? The pet store brand / company, right? I want to take a look at them because their share price is absolutely destroyed right now to about $17, right? That being said, their market cap is about $7 billion. Last year, they made about $10 billion in revenue, and they seem to now finally be profitable, and their growth prospects for the near-term future are fairly good. Look, EPS is going to start getting really, really nicely positive, and their revenue growth is still fairly decent. So I really want to check on what's happening with this company and see if there might be a little bit of a cheeky trade to be making at the bottom levels here for a potential turnaround story for this company, right? So with all that being said, guys, let's get into our technical analysis right away, and we're going to break down some of the important levels for you guys. So taking a look at SPY right away, you can see here that on the day today, we did close below the 12 EMA, and the chart that I really want to focus here on, guys, is the S&P 500 futures chart, because we can see we're still in this rising wedge, and with today, we're really coming close to cracking that to the downside. If we use, this is usually a bearish pattern, and if we break down below and retest this as resistance, most likely we're going to get some follow through. So this is red flag number one on the futures chart. On the traditional S&P 500 chart, you can't see it that well, but we are still trending in this trend line right here. That being said, guys, the bulls have just lost the daily uptrend. We were in a nice daily uptrend, and I was saying, keep an eye on this low right here. Well, lo and behold, no pun intended, we have now cracked that low, and the S&P 500 is now on its first daily downtrend since pretty much the month of December. So it's been a while, so it has to be notable to us. Also losing the 12 EMA and now coming into the bottom portion of our trend line. We'll be keeping a very, very close eye on this line here for the S&P 500 and also the break potentially of the rising wedge here on your futures chart, which pretty much shows the same thing. It's just not as clear on this chart. I could draw it on this chart as well. It's just not as clear. You really see it best on that futures chart because you really have no gap up and gap down opens, right? It's just really streamlined. So that being said, guys, those are levels we're watching out for. Bears now in short-term control. And notably, guys, this is the second red week that we've closed in a row. When is the last time that we closed 2 red weeks in a row? You'd have to go all the way back to October. And prior to that were the events of the sell-off, which started end of July last year, right? So has to be notable to us, guys. Also, 2 weekly doji candles does show a little bit of bearish lean for the market. Your MACD momentum is kind of fizzling out. Your RSI as well is still overbought on the SPY weekly. Could be due for a little bit of correction. So we'll be watching out for these levels extremely closely, guys, right? Now that the bears are in short-term control. If they get follow through and break this trend line, we will be in for some healthy weekly consolidation. At that point, guys, anything really above, I mean, they have so much space. Anything above 466, right? Just a weekly higher low for further trend continuation. And I'm expecting at most, guys, maybe a 5% drawdown on the S&P 500. That would put us about 492, 490 on the SPY. Not that big of a correction if it does happen, in my opinion. Moving on to QQQs now. Big structure break. QQQ actually lost the trend line today. Look at this, guys. This hasn't happened pretty much since the rally started in November. Has to be notable to us, right? They also lost the daily uptrend. We were looking to protect these lows right here, 435-ish, and I said, keep an eye on this. Why? You're 435 on the QQQs. You can't see it that well, but on the NASDAQ 100 futures, that was this level right here. It was 18,000. So we have to be very cautious of this. Now we've lost the 18,000 level. On the futures chart, you can see as well, we've lost the short-term moving averages and we've lost the trend line at the same time. Now, it's obviously only for one day, but Jerome Powell on next Wednesday is going to be absolutely crucial for the bull's capacity to either recover this, look below, and recover quickly, or really send us into a daily downtrend, which would perpetuate weekly downswing as well. So QQQ, very notable break of a couple of levels here today. Your daily bears are now in full control, daily downtrend on the NASDAQ and on your QQQ as well. So bears in short-term control now, in the driver's seat, loss of both of your moving averages. I know it's happened a few times in the past, but not with a break of the trend line as well. It's broke it ever so slightly, but that's what we're going to be looking out for next week. Do we get follow through continuation? And if it does this, guys, break below, retest this. This is going to be another opportunity for me to add to a potential short swing position to really get more of some of that weekly consolidation here. At least on the QQQs, they do have a somewhat amount of space available to them. Anything above 422, just going to be looking for a weekly higher low. If ever we lose the weekly uptrend, well, at that point, guys, we're just looking for a healthy monthly consolidation. At most, if things get really, really nasty, we could see a retest of our previous all-time highs, which from top to there would be about roughly 8-9% to the downside from the top. So not that big of a sell-off, but would still be notable, and that would provide a very juicy opportunity, monthly higher low for big buying opportunity for the remainder of 2024, in my opinion. So that is just a couple of things that I'm watching out for. Take a look, MACD approaching the crossing point, and also RSI pointing to the downside. So we may be getting a little bit more momentum to the downside. Jerome Powell is going to be key next week, guys. Now, give me a second before we do financials. All right, sorry about that, guys. So in terms of financials here, financials also on the day, having a relatively muted day, 0.10% to the downside here. And what we were looking out for here was this rising wedge that I had pointed out on the channel as of yesterday, right? Clear rising wedge. Once again, guys, this is a relatively bearish pattern in motion right now. We still haven't lost it. The bulls did a good job protecting it today. But if we do get that break right here, we're going to break a couple things at the same time, right? If we lose this, we're going to lose this rising wedge pattern. We're going to lose the daily 12 EMA. The daily 12 EMA, this yellow line right here, has been such a solid such a solid moving average support for the financials market as a whole. If we lose that, guys, and look below and set the daily downtrend on financials, well, weekly consolidation is going to be underway. And keep in mind, guys, we are still in our area of resistance right now. Previous all-time high resistance zone, 40.6 all the way up to 41.5 roughly. That's what's rejecting us right now. So I'll be very curious to see if we do lose this into next week, guys. Daily downtrend, let's say, it'll be weekly consolidation, anything above 37, just looking for a weekly higher low, and that'll be very healthy weekly higher low consolidation before maybe making a second attempt at the higher portion of your previous all-time highs. So financials not looking that bad yet, just a few key things to look out for the near-term future. Now, healthcare also coming dangerously close to our lows, guys, 144.60 roughly. We pointed that out in yesterday's video as well. The bulls had the daily uptrend, but now in just a few days, guys, we're retesting these lows right here, right? Lose these lows, you lose the daily uptrend, and you set the bears up for potential daily downtrend. If we do get that, guys, it will be notable to us because we will just be in further weekly consolidation. Areas of support, previous all-time highs, talking about 142, very healthy retest area for the bulls, in my opinion. And in terms of your daily here, guys, we lost the 12 EMA as well. Healthcare has lost the 12 EMA moving average a few times since the rally, but never at a point where it was in weekly consolidation mode, right? That has to be notable to us. So I'm going to be keeping a close eye on QQQ, financials, and healthcare for losses of key levels. QQQ, loss of your trend line, loss of the daily trend as well, loss of your moving averages. Financials also, right? Rising wedge into lower level consolidation plus loss of the 12 EMA. And your healthcare sector, loss of the 12 EMA, which has been such good support, and into further weekly consolidation as well. So all things, guys, coming into major areas that can break them. Now moving into the Russell. So Russell, 0.19%, a little bit of green on the day for the Russell, despite the rest of the market selling off here, right? So the Russell still in a bit of a daily downtrend at this point. We know that the bulls had lost the previous daily uptrend when they cut the lows, lower low, lower high, lower low, daily downtrend confirmed at this point, which means we are just in healthy weekly consolidation. Anything above 187.50, just looking for a weekly higher low for further trend continuation. Now, if the rest of the market continues selling off, I do believe the Russell is going to come down into this red box right here, which is previous big resistance, should be acting as a nice little area of support for the bulls. I want to get as close as possible to 195 to be making a swing trade position myself. So that is what I'll be looking out for on the Russell. As of now, your bears are in short-term control. We're just looking for that beautiful weekly higher low. So keep a close eye, guys, on the 190 to 195 level. It's going to be absolutely crucial to protect this for the bulls, in my opinion. And now lastly, our Dow Jones. So the Dow Jones here, guys, breaking down below our horizontal area of support. Once again, getting close to our lows, 38,500. If you lose 38,500 coming into next week, you may just be able to roll this chart over again. As you can see right now, the bulls are in short-term control, still have the daily uptrend. This is potentially a higher low if we break to higher highs. The reason I focus on the lows here, guys, is because of all the other factors that we've been previously talking about, especially in yesterday's video as well, right? So if the markets turn negative and we lose this level, it will just be healthy further weekly consolidation for the Dow Jones at that point. Anything above 37,150, just looking for a weekly higher low for further trend continuation. Now, take a look, guys. Look at this MACD, right? Crossing above. The weekly has been overbought for a significant amount of time here since January. May just be some time to cool this off. And even if we take back a lot of this move coming down to the 37s, well, it'll just be for a monthly higher low for further trend continuation later into 2024. Long-term bulls are in control. Just maybe some time now for the weekly bears and the daily bears to put in some larger moves to the downside. Now let's do a little bit of crypto very quick, because we did lose a couple levels here recently. Now we lost the 12 EMA yesterday. We saw we were able to recapture it. However, the bulls are still in a very nice, healthy daily uptrend. Anything currently above 59,603, still just looking for a daily higher low for further trend continuation. I'll be keeping a close eye over the weekend on this trend right here. MACD cross as well on Bitcoin, guys. Now, I know in the past it has happened here, where we did lose the MACD. It crossed for only 3 days before resuming this monster rally to the upside, but still has to be noticeable to us that short-term momentum is waning out. We'll be keeping a close eye on the weekly candle close. Keep in mind, it does close on Sunday. No red flags here as well. Even if we were to pull back too much, set a daily downtrend in motion here, it'll just be for very healthy weekly consolidation. Anything above 39, guys, just for a weekly higher low for further trend continuation. If we do pull back, guys, I'm expecting the previous all-time highs, 60 to about 65, let's call it, where most of the trading happened in this area, right? That's where I'm expecting the bulls to pull back into, and that would be a long-term dip buying opportunity in my opinion. So Bitcoin, not looking too bad. Now moving on to Ethereum. Ethereum also consolidating ever so slightly, right? So we've been in this very beautiful daily uptrend for a very long time at this point, right? Now, we have to consider, guys, that we did lose the most recent higher low on Ethereum. However, this level right here, 37.61. So now the bears are in short-term control. If we set the daily downtrend, as on Bitcoin, it's just going to be for a little bit of weekly consolidation. Anything pretty much above 2,100, guys. Just looking for a weekly higher low for further uptrend later on in the year. And if we do pull back here, guys, I do expect the 3,000 level to be very decent support. The 12 EMA is down there as well. So that should be your first line that we are going to be targeting in terms of your price targets for Ethereum. It's actually the latest area of minor consolidation as well. But keep in mind, from the top, guys, that would be a significant drop, 20+%. Your MACD is also pointing to the downside in terms of the daily as well. So momentum is currently favoring your short-term bears. So going to be keeping a close eye on this. Ethereum, if we can come back 3,200 to 3,000, that's where I'm looking to pick up a little bit more Ethereum myself. Now, moving on to our big tech names, guys. So let's take a look at Apple first off. So Apple, not a bad day for Apple, all things considered, guys. They were actually down significantly on the day today. I mean, we were talking about over 1% at one point, 1.3%, and now only down 0.22%. So Apple holding up better than most. We've been looking at Apple's ability to hold up these lows right here, right? Daily bears are still in full control of this chart. However, we were looking at the size of the bounce to see if the bulls had the ability to reset the daily uptrend. Now, the size of the bounce was relatively weak. However, Apple's done this before, where we've had a relatively weak bounce. They did protect the double bottom, and then we had a rally. So we'll be looking for the bulls to do the same thing. Can we protect this level right here, 168.75? In my opinion, guys, Jerome Powell holds the key to this. If there was no meeting next week at all, right? And it was just a normal week of trading, no CPI data, no inflation data, no nothing, no Jerome Powell. Apple may have a fairly decent chance of catching up to its peers, but Jerome Powell really holds the key for next week, guys. One thing's for sure, if we break 174.36 to the upside, it will be a new daily uptrend for Apple, the first one since back here in January, and then we will look to the size of the weekly move higher, which I need to personally see get up at least on the weekly move. Let's say this pulls off a daily uptrend right here. I need to see the move at least into 180 on the weekly to give themselves the best chance of doing the same thing on the weekly. Reset the weekly uptrend progressively over the next couple of weeks, couple of months, right? That's what we're looking out for on Apple. MACD cross to the upside. So we are trying to build some bullish momentum. But as I said, Jerome Powell does hold the key to a lot of this market next week. Low side, obviously, guys, if we just flush this right here, your daily downtrend simply continues, and then we'll be looking to our lower level of support to act as our last line of defense here. 165, crucial level for Apple to hold in the near-term future. All in all, not looking too bad. I'm still very interested in playing Apple in these lower levels. Now, moving on to AMD. AMD also pulling back on the day here today. Well, actually not that much, 2.14% to the upside. Not pulling back at all. I was thinking of NVIDIA, my bad. So AMD was actually up closer to 3.5%. They pulled back in the later part of the trading session. AMD reacting beautifully from the level that we pointed out here in the last couple of days on the channel, right? So this previous consolidation range, the top end of it, 182, let's call it, is currently acting as support. The bears do have downside continuation right now. Daily downtrend in motion. It'll be up to the bulls to prove to us with a sizable bounce if they want to reset this and really put an end to this weekly consolidation. As of now, it's just healthy weekly consolidation. Going to be looking heavily into this big chop zone to act as support. So even if we break into this zone a little bit, there's a lot of congestion right here, guys, all the way down to about 160 levels, which is your previous, obviously your previous all-time highs, right? So the worst case scenario is AMD pulls back into this area and consolidates sideways a little bit. That is really your worst case scenario that the bulls can be looking at. All in all, it would represent better value, in my opinion, if we do come down here. That being said, the bulls currently holding this up as resistance, and we are still in control of the overall weekly uptrend. So AMD is one. If we come back a little bit more over the next couple of weeks, I will be looking to play it, guys. I want to get as close as possible to 160 for my swing trade personally. Now moving on to Amazon. Amazon also 2.5% to the downside. Amazon, guys, still unable, right? We've been talking about this now for a couple of weeks. Still unable to break this 178 big previous all-time high resistance. And once again, we tried it in the morning and we failed. So now Amazon, we will be looking whether or not we lose this low right here, 171.50. Key level. Why? Because if we lose this, well, we'll just go back into a daily downtrend at that point, and we just be on for further weekly consolidation. You can see Amazon doing really nothing over the past 3 weeks of trading, just stuck at this resistance level pretty much. So if the bulls can't get it done, we're going to be looking for more weekly consolidation. Keep an eye on this level. 166, guys, is going to be crucial. If we lose 166, then we are undoubtedly going to go, which is the big support level here, 166. If we lose that, we're going to the gap fill area, which is going to be around 160. 160 is where I personally want to buy some Amazon myself. That would represent a very good monthly dip buying opportunity for further continuation and potentially for a further stab at your previous all-time highs, maybe after we get through a little bit of a negative cycle in big tech. Now moving on to Google. Google down about 1.5%, but Google can afford it. Google did a great job, guys, of this bounce. This is the type of bounce that I would like to see on Apple, right? Just hasn't happened yet, but Google was in the same situation. Extended daily downtrend from the month of January, pretty much after their earnings. Now they have just engulfed the previous leg down, which is what we love to see, and we're back above our crucial area of previous resistance, 141 to 138. It was used as support. We're now back above it. So big area. Back above our moving averages. I like it, guys. Now, any dip right now, just going to be looking out for a higher low, anything above 131.70, higher low for further trend continuation here, getting the daily trend back to the bulls and putting an end to this weekly drawdown that Google has been in. Also putting an end to potential monthly consolidation too. Google, in my opinion, guys, coiling up for a next leg up, another potential stab at your all-time highs in the 150s. I love Google at these levels. If we get the breakout, retest of the zone, I'll be targeting as close as possible 138, 137 for a swing trade over the next 2 weeks. because Google's value is relatively good down here. Now moving on to Meta. So Meta also coming down 1.5% to the downside, right? Key level we're going to be watching out for 477. Lose 477, it'll be Meta's first daily downtrend since pretty much the month of November right here when they set the daily downtrend, right? Have not had one since then, so will be notable to us if that happens. Now, today we did lose a couple of key items, right? We lost this previous resistance, which was now support line. We lost that. We also lost the 12 EMA. Have not lost the 12 EMA since pretty much the month of January right here when we lost it ever so slightly. So we'll see if this sell-off continues. We'll just be in for weekly consolidation on Meta, and then we look to the weekly lows to appear as support. 455 pretty much. If you lose 455, you're going to lose the weekly uptrend. It won't be a downtrend. Downtrend, you need lower high and lower low. It'll just be a loss of the weekly uptrend. And if that happens, guys, loss of the weekly uptrend, it'll just mean healthy monthly consolidation. It just means you'll have to wait a bit longer as Meta will then have to potentially two-step recovery this, which is something that they've done in the past, right? We lost the weekly uptrend right here, cutting these lows, and then they had to make 2 attempts at reversing this, right? So that is potentially a scenario I'm looking out for. If ever that happens, guys, you know me, my levels for Meta, it's not on the chart, but 440 down to 420 is the area I'm looking to play on Meta. And from the highs, guys, that would be a significant discount, right? If I take the midpoint of that, it would be down about 15, 16%. Very good shopping area for Meta, in my opinion. So we'll be keeping a close eye on that. Now moving on to Microsoft. So Microsoft not looking too bad, even though it's down 2%. We're still above our area, our big range that we just got through, right? So Microsoft is currently in a daily uptrend. We are just looking for a higher low, anything above 401.60. Daily higher low for further trend continuation. I was wanting Microsoft to protect this upper area, which was the resistance area, which they did beautifully today. You can see we tried to dip under it over the course of the morning, and then they recovered it late into the afternoon. We'll see if they can really maintain this area. If ever they get trapped back into here, guys, we may just end up in a scenario like this where Microsoft has to consolidate sideways for a bit longer. But the valuation on Microsoft is not so bad. If for some reason we get dragged down by the entire market and lose this range, we will tackle that when we get to it. At that point, you guys know me, 380 is going to be the range that I really want to buy in. But for now, the bulls appear in full control, and we have also tried to make a weekly breakout, not completing it yet. So on the weekly, guys, we are still in a little bit of a tightening range, even though you did have a break on the daily. Need to see Microsoft hold this into next week. If not, guys, then if we pull back, and we definitely need to hold this lower end of the support range, which is about 399. So essentially what I'm saying, guys, might be a bit confusing on Microsoft here, but Microsoft, the short-term bulls are in control, your longer-term bulls are in control, but essentially Microsoft can't do it on its own, right? If the whole market kind of falls apart next week and goes into weekly consolidation mode, I don't believe Microsoft is going to be the lone star stock that just persists in this daily technical breakout just because it broke out of the range, right? It'll probably come back in, and if the market gets really bad, it may even lose it. We may set up for a bit more weekly consolidation. At that point, my trade will open up in the 380s. Now moving on to Netflix. So looking at Netflix here, guys, 1.16% of the downside. Netflix really had a gap up open on the morning and sold off all of it intraday. So top to bottom here from the gap up open is about 3.5%, even if it just shows they're down 1.16. So that's a notable sell-off for Netflix. Netflix as well, guys, unable to get through this big area we keep looking at, right? 620. 620 is proving to be very challenging for Netflix, and that was shown once again today when we tried to break it and unfortunately closing below. Lack of follow-through by a lot of these companies on those breaks, right? So we're going to be keeping a close eye. 595, guys. Lose 595 and you do lose the daily uptrend. It would be daily downtrend confirmed at that point, and you would be looking for a weekly consolidation. Anything above 550 on Netflix, pretty much weekly high or low for further trend continuation. And we do have a big level that we broke through, 575, which should be acting as further support for the stock. When we come back in there, that's level number 1. And obviously your bigger level is 550. Personally, myself on Netflix, guys, if the market gets really bad, I'm looking for a deeper sell-off anywhere in the 520 area is where I'm personally looking to add some Netflix shares that will represent from top to that range, roughly a decline of about 15%, right? So has to be a heck of a sell-off for that to manifest. You can see back here, if we take a look at the September sell-off, it went further than that, about 24. But Netflix all the time does have these, relatively quick and fast pullbacks of about 10, 15%. So that is one that I may be looking to shop for if it does happen. Now moving on to NVIDIA. So NVIDIA, guys, a couple things notable on NVIDIA, right? We are still in a tightening range at the top right now. So your daily bulls are in control. It's a tightening range. We need to watch out for this 840 level, guys. Lose 840. First daily downtrend on NVIDIA since pretty much back here the month of December. So that will be notable to us, right? Daily downtrend, rolling over of the MACD as well. Negative signal there as well, right? On the weekly, it would just be very healthy weekly consolidation. And you can see, guys, heck of some wicks in the last 2 weeks. So if you roll over on NVIDIA, guys, first level that I'm going to be looking out for is your prior to earnings highs, 740, and the lows of earnings before earnings, 660. That's going to be a big range right about here that I'm looking out for. It's in line with our moving averages, and it would be relatively a 40% pullback from the highs. So that's the area I'm looking out for on NVIDIA. Not saying we're going to get it, but if we do get it, guys, that is where I'm looking out for. So moral of the story, your bulls are still in control. We are still just in a tightening range, but one that has already started a daily downtrend, guys, is SMH, the entire semiconductors index as a whole, daily downtrend, right? So that is something we definitely don't like to see. And even on the weekly, guys, weekly can have some space to pull back to this 12 EMA. So if semiconductors as a whole do consolidate, NVIDIA is obviously part of that. I don't think they'll be able to hold it up on their own. So if we do see that consolidation, heck of a buying opportunity because your long-term bulls are obviously in full control. And now moving on to Tesla. So Tesla not looking too bad today, 0.66% to the upside. Really struggling, guys, at the lower bound of this trend line right here. You can see we're barely closing above it the past 2 days. If I zoom in on these candles, look how close we are, right? So that's pretty much what's acting as defense. Our last line of defense after that to the downside, guys, really becomes these lower levels right here, right? We're kind of struggling at them right now. 153 is your last stop, but this whole area, 160 to about 152 is your last line of defense before you really start getting the lower levels. So Tesla bulls really have to start putting up a fight now, or we're going significantly lower, in my opinion here, guys. Daily downtrend is fully in motion. Your 1 hour bulls are still not in control of the stock. Still need to see some hourly trend change for the bulls, but we haven't got it just yet. Excuse me. Then when the hourly trend change happens, we look at the size of the bounce. We are going to need to get as close as possible to 183 to give ourselves the best chance of resetting the daily uptrend to the upside and mounting back above this big, these two yellow lines, which were our big previous support areas. Well, we're now below them, so they'll be acting as resistance. So on the next push, really need to see the bulls get back above this. In my opinion, guys, however, there's really no rush to get into this trade since the bears are in big control of all your major time frames, right? We first need to reverse the daily, and that would be a sign for a bullish trade. Until that happens, I'm really not interested in trying to pick the bottom of Tesla. I would rather just let this one kind of play out on its own. And then once we finally do get a significant daily uptrend move by the bulls, that's when I'll be looking for potential weekly positioning and playing Tesla a bit more aggressively. But for now, guys, kind of just a falling knife right now. Excuse me. Moving on to Palantir. So Palantir cracking the lows. This has to be notable to you guys, right? So we were in a daily uptrend, now losing the lows. So we're not in a daily downtrend yet. That would be lower high, lower low, but we did lose the lows and lose the daily trend as a byproduct, right? So now with this consolidation, it means we're into weekly consolidation. The line in the sand level for weekly, guys, is about 22.25. Lose that, and unfortunately, you lose the weekly uptrend as well. Why is that not so much of a problem? Well, there's so much space on the monthly here, guys, right? We're just looking for maybe a little bit of a monthly pullback if the rest of the market does, slightly fall apart here. And to that aspect, we're going to be looking at the lower bound right here. $21.50 to about $20 is going to be the big range. Bottom end of the 2020-2021 range, and also previous 52-week highs. So this area right here should be fairly decent support. I will be looking to play that level if ever Palantir does start challenging these lower levels. That's where I'm really interested. So now short-term bear control, even on the weekly, guys, getting very close to this level, right? Bears taking back a lot of the move. It's just, we're just going to be curious to see come back into these levels, much stronger support, in my opinion. That could be a decent area for some swing trades. And now lastly, our PayPal. So PayPal, not looking too bad, 0.25% to the downside here, still holding the levels as best as they can. This green line where we're rejecting from, guys, is the 200-day moving average. We haven't been above the 200-day moving average, guys, since 2021, October, right? So we're still getting rejected by that 200-day. At least, guys, we're above this downtrending channel line that we've been keeping an eye out, we're really doing a nice job at breaking that. So daily uptrend, any daily consolidation, just looking for a higher low above 58. And we are looking for the potential ability to maintain above this trend line and start gaining the levels. It's good that we're above this downtrending channel line, guys. The only negative thing is with my overall short-term bearish view on the markets, it's very possible that once again, PayPal cannot do it on its own, right? If the rest of the markets consolidate for maybe the next 1 to 3 weeks, let's say, well, unfortunately, PayPal will probably get dragged down as well. So although I do like this breakout, I am fairly cautious on its ability to keep gaining the levels throughout this. If, we were in different circumstances, if PayPal had done this prior back in January or February, I would say it's a no-brainer before we got so much negative news on inflation, right? And potentially pushing back interest rates because PayPal's an interest rate sensitive stock. I would have said, yes, the breakout is all but guaranteed and we're probably going to 75. But at this point, guys, have to be a little bit cautious. In my opinion, I would be interested, guys, if the stock does have a little bit more of a dip back down into the $60 range, maybe even retesting, high 50s, 58 or whatnot, and we lose this again, I may be interested in making a little bit of a play here, $58, $57. But for now, nothing bad to say. The bulls are in full control. I'm just, it's my overall view of the market that's kind of holding me back from being overall bullish on this one. But the technicals on the stock itself, guys, are not looking bad at all. We now have our weekly breakout as well. So we have done a great job here of protecting these weekly lower lows at the $57 range. And now we're getting a little bit of weekly trend expansion. So love to see it on PayPal, but will it be just a case of too little, too late for PayPal? Considering the market environment that we may be going into, that is what we'll be looking at. So hopefully you guys enjoyed the video. A bit long right now, guys. In terms of the portfolio, no change from yesterday. Still sold everything. The covered calls are still in place. The short trade on NASDAQ futures is still in place. And now that we're in profit, guys, our stop loss literally just goes to break even pretty much. And I really took this one, relatively close yesterday to the 18,050, 18,060 level. So that's where my stop loss is right now. Stop loss at break even for now, just riding that trade. And I said, if we do get a break and retest of this range, I will most likely be looking to potentially add a short position to this, maybe another contract here and ride it down a little bit further. So really no portfolio updates as of today. That's why I'm really not showing it to you guys. Made a little bit of gains today because some of the covered calls, Nike, Baba, and Apple, some of the covered calls did make some decent profit because those stocks either stayed flat or did nothing. And the short had some decent profit. We're now roughly up about $300 on that short, nothing big. So all in all, guys, fairly decent week, and into next week, I'll be very, very conservative with the positions that I'm going to write. You guys are going to see that. So I'll see you guys on Sunday for the top 5 options for the upcoming week. Hope you guys have a very beautiful weekend. Until then, take care and peace. The market leader, well, let's take a look at their valuation rights because I did that as well. Did I actually do it?